Absolutely delighted to have Javier Sáenz de Cenzano and Adam Rozencwajg here with us today. Javier leads the External Managers Unit at Asvalor Asset Management and is the portfolio manager of the Asvalor Managers Fund. Prior to joining Asvalor in 2018, he was Director of Manager Research for EMEA at Morningstar, where he worked for 10 years. He also worked as a Manager Research Analyst at Russell Investments in London and at Allfunds Bank in Madrid. Overall, he has more than 20 years of experience in fund and manager research. Javier has a bachelor's degree in business administration at CUNEF University. He also regularly gives lectures on financial markets, analysis, and investment funds at different universities and has published articles and interviews in prestigious international financial sector media. Adam Rozencwajg has over 15 years of investment experience. He is a managing partner at Gehrig and Rozencwajg Associates. Between 2007 and 2015, Adam worked exclusively on the Global Natural Resources Fund at Chilton Investment Company with Mr. Gehrig. Prior to joining Chilton Investment Company, Adam worked in the investment banking department at Lehman Brothers between 2006 and 2007. Mr. Rozencwajg holds a Bachelor of Arts degree with a major in economics and philosophy from Columbia University. Thank you both for joining us today.
Okay, thank you for your introduction, Itai, and thanks Brown University for having me. I believe Asvalor is the first Spanish investment firm that features on your online events, and we feel tremendously honored to be invited today to such a prestigious program where so many legendary investors have featured in the past, and because it's run by an Ivy League university we greatly admire, like Brown University. Before taking questions, I'll do a brief introduction on Asvalor as a firm in terms of history, background, and main features of our corporate culture. And I'll also go through our Asvalor Managers strategy, covering what it is and how we build the portfolio. So Asvalor is an asset management company founded in 2015, independent, fully employee-owned, with strong skin in the game culture. We invest our personal financial assets in our own funds as a way to be fully aligned with our co-investors. We truly believe the one and only way of being good stewards of capital is to invest alongside our investors with the same exact terms. In that sense, we are not an asset gathering firm, but investment centric, focused on investments and on delivering long-term returns. Accordingly, we strive to ensure our investors understand our investment process and, probably more importantly, share our long-term investment horizon. In terms of the firm setup, we have offices in Madrid and London. We currently run around 2 billion euros in total and have around 35 employees overall. We've publicly committed to a maximum assets under management limit of 2.5 billion euros on our core direct equity strategies, which we are not too far from at this point. We have one only investment team and one investment process on our direct equity funds. And in that regard, we are specialized in long-only fundamental bottom-up stock picking with a deep research mindset, a strong focus on valuation, and a willingness to be contrarian if need be. We basically invest in businesses we can understand, looking at them as if we were buying the entire company. We don't pay attention whatsoever to benchmarks, and we believe volatility and risk are two very different things. So we will basically manage risk through a thorough understanding of our invested companies in order to try and avoid permanent losses of capital. And then in terms of Asvalor's executive team, we have 4 founding partners, 3 of which worked together previously at another investment boutique called Bestinver Asset Management, where they delivered excellent long-term returns, massively outperforming the market prior to founding Asvalor in 2015. Investment heads Álvaro Guzmán de Lasso and Fernando Bernat actually started working together in the late 90s at a value investment firm based in Frankfurt. They joined Bestinver in 2003 and 2007 respectively, and hence have worked together for quite some time now. Lastly, on Asvalor, I'll mention that Álvaro and Fernando are co-CIOs, having featured on many top investment-related publications like, for example, Value Investor Insight, They have been speakers at high caliber conferences around the world and also appeared on a book called The Value Investors by Ronald Chant a couple of years ago, where they feature alongside some legendary investors like Howard Marks, Walter Schloss, Irving Kahn, Jean-Marie Aveyard, and some others. Very interesting book that I strongly recommend, that covers not only these managers' investment style and process, but also their background and personal profile. Alvaro and Fernando run two main strategies, one that invests in Iberian equities, so Spain and Portugal, and the other one more international in nature, but both applying the same exact investment process. And then besides those two strategies, and moving on to the second part of my introduction, we also manage a strategy called As Valor Managers. So what is As Valor Managers? I joined the company in 2018 to develop this new initiative, leveraging on, 20 years of experience doing manager research. So we basically created a long-only global equity strategy to invest in best-in-class boutique-type external managers. The purpose of this strategy is firstly to diversify our own personal investments, since, as I mentioned earlier, we invest our full financial wealth in our own funds. And secondly, to offer it to investors that want to join us on this long-term journey. So what is the process behind As Valor Managers? In essence, we conduct extensive qualitative research on equity managers worldwide. Do you know how many investment funds exist in the world? It's actually more than 300,000 funds. So it's an overwhelmingly large investable universe. And we also know that only a small minority of managers beat the market in the long run. The good news, on the other hand, is that we know exactly what we look for in our managers, which is the following. We basically look for investment boutiques with stable and vocational close-knit investment teams, firms that are specialized in a single strategy, in a single investment process, managers that must have a strong stewardship mindset and substantial skin in the game through personal investments in their strategies. Investment processes focused on long-term stock picking, concentrated, unconstrained portfolios. Firms that run a reasonable level of assets under management and that are capacity mindful. Managers that have lengthy experience managing money and that have in place robust operational setups. So in essence, basically managers that are similar to us, to As Valor, not necessarily in terms of the same exact investment process, but like-minded on the corporate culture and overarching investment principles. So now comes the hard part. How do we find and select them? Our idea generation on our manager selection process is purely qualitative. So in order to find managers, we conduct a sort of scuttlebutt approach applied to manager selection. We talk to private and professional investors worldwide through an extensive global contact network built over the last 2 decades. We attend niche type conferences. We fiercely read articles from managers, interviews, investment books, and all kinds of investment literature and publications. And of course, we ask managers about other managers that they like. So we kind of scout the global market to generate ideas, and always avoiding any kind of quantitative approach or inputs based on past performance. As Peter Lynch used to say, in investing, the person that turns over the most rocks wins the game. And we apply that approach to manager selection, essentially. At As Valor, we've looked literally at hundreds of managers, which obviously requires a lot of time and effort, and we keep looking, on a continuous basis. But then after we generate those ideas, the second step is to conduct extensive research on the managers that we are interested in our early stages. And that includes all kinds of inputs and analysis on both tangible and intangible. I mean, we read all investor letters published by the manager since the firm's inception. We analyze the manager's background and prior experience. We try to delve deep into the investment process and fully understand the research and stock selection approach. We, of course, analyze historical portfolios held by the manager to try and identify inconsistencies in the execution of the process. We read and watch all interviews they have given throughout their careers. We visit their offices. We run reference checks with other investors that have held now or in the past a position, an investment in that manager. And in essence, we try and cover all angles that an outsider analyst is in a position to comprehend. And then, and this is critical, I think, at some point in the process, when we've built a reasonable high level of conviction, our co-CIOs, Alvaro and Fernando, that I mentioned at the beginning, jump into the process to do the last mile analysis. So they basically talk to the manager directly, so portfolio manager to portfolio manager, to discuss investment cases, to challenge some of the managers' investment thesis, which we think elevates the dialogue to a whole new level. We believe by doing that, we can potentially, hopefully, identify weaknesses or inconsistencies on a given manager's process. So we strongly believe it makes our process, our manager selection process, much more robust, increasing the odds of making a good call on our eventual manager selection. The ultimate question we make to ourselves, kind of the litmus test, is the following: would we invest our entire financial capital on this manager? And we only go ahead if the answer is 100% yes. So as you can see, our research process is very deep, very extensive, we like to believe. And our approach is to partner with the managers for the very long term. And in that sense, we don't make decisions or change our view due to performance. On this front, our approach is to be very close to the managers through an ongoing monitoring process in order to go just beyond past performance and to focus on fundamental aspects of the strategy, on the portfolio, on the process, on the team, on the corporate culture, and just to make sure that everything that we like when we invested in the manager are things that are still there, and as long as we have conviction on those elements, we will stick to our guns through thick and thin. So I'm just getting to the end of my introduction. I'll just mention that the managers execute and build the portfolio on our behalf. And the outcome is a portfolio of around 120 stocks at the moment, broadly diversified across regions and sectors, and with a strong bias towards micro and small cap names. Our overlap with benchmarks is close to zero. We are really benchmark agnostic. We don't pay any attention to that. And our managers tend to find ideas in, of the beaten path stocks, sometimes companies with very limited sell-side coverage, sometimes companies that are not really well known by the market, and usually taking a contrarian view. So in a way, as Valor managers, the way we see it is that it enjoys the benefit of diversification because it's a diversified portfolio, but with the advantage that each manager is pretty concentrated, so they can carry out extensive, exhaustive research on each investment in a way. We have several top investment teams working for our fund on an independent, but on the other hand, complementary manner. We currently have 4 managers in our fund, same 4 since we started this fund in 2018. One of which is Gering and Rozencwajg, and in a minute I'll let Adam explain who they are and their investment approach, their process, etc. But I'll just say one thing, that we consider them to be actually the best natural resources equity team in the world. I think that's it for the introduction, and now I'll be more than happy to take any questions from the audience.
Yeah, that sounds terrific. Thank you so much. That was a really great presentation. And maybe begin by also describing a little bit about your career journey.
Sure. Well, I've been doing manager research for my entire career, a little more than 20 years now. After an internship at the Spanish Central Bank, where I was doing accounting, I joined Allfunds Bank at the age of 22. Allfunds Bank is now the largest fund supermarket platform in Europe. And actually, interestingly, there I worked with one of Valor's founders. So we've known each other for more than 20 years now. Then after Allfunds Bank, I moved to London to work at Russell Investments, the kind of largest multi-manager investment firm in the world. That was a great learning experience on so many levels. And then in 2008, I joined Morningstar, the American company, when Morningstar was kind of building up from scratch their European manager research analyst team, and kind of replicating what they had in the US in terms of a relatively large team of analysts that they did have in the US but didn't have in Europe. So they kind of recreated that in Europe. And after a few years, I luckily became the head of the EMEA team of analysts. And also coincidentally, in my early days at Morningstar, I happened to be doing analysis on the funds that the co-CIOs at Asvalor, Alvaro and Fernando were running at their previous firm, Bestinver. So that's how we got to know each other. And then in 2018, I joined Asvalor, as I mentioned, to create from scratch the multi-manager investment arm. And we launched our first vehicle at the end of 2018.
And you spoke a little bit about the co-CIOs there, but what are some of the key things that you learned from Alvaro Guzman de Lazaro and Fernando Bernard?
Well, as I mentioned, I've known them for almost 15 years now. I think I hold them in huge respect and to me they were the perfect partners to launch this business. But obviously the proximity we've had in the last 4 years has been a great learning experience in so many aspects, both personally and professionally. If I had to pick one specific thing, I would probably highlight their via negativa mental framework. It's a very ancient concept, comes from the Latin, and its translation would be the negative way. The concept has become more popular after Nassim Taleb wrote about it in his Anti-Fragile book. But in essence, it means that in many aspects in life and in investments, it is more beneficial to first figure out what not to do rather than what to do. And I think the direct application in our manager selection job is pretty obvious. I mean, we invest, as I mentioned, in very few managers, and there are literally thousands around the world. So we say no to probably more than 99% of the managers we analyze, most of which actually look very good on paper. So our approach is to try and find reasons not to invest with a manager, which we believe makes the process more anti-fragile in Taleb's terms. And I think the same should go probably for an investment in my view. I mean, do your homework, try to break the investment thesis as hard as you can, because that would reduce as much as possible the likelihood of making a mistake.
Yeah, absolutely. I think that makes a lot of sense. And let's say you have a new fund manager who you hired or you invested in, but he or she underperforms the first year, 2 years, 3 years. How do you decide whether to stick with that fund manager or whether to transfer capital outside their fund?
That's a very good question, Itai. Well, we actually know that all active managers in the world have bouts of poor performance and sometimes severe underperformance, and sometimes for a very lengthy period. It's just part of the game, and one needs to evaluate the reasons for that performance and whether it's driven by a permanent loss of capital or just by having a strong market headwind. There is actually a paper called I think it's Investing in a Bubble by US company called Verdad Capital, which reviews the tech bubble in the 90s and how investors, the likes of Ray Dalio, Peter Lynch, Howard Marks, Seth Klarman, Warren Buffett, have all warned about the bubble that was developing in the market. And some of them as early as since 1995. So they were early in their view, in some cases by 5 years. And then in December 1999, the Wall Street Journal published an infamous article saying something like, "What's wrong, Buffett?" And that was just 3 months before the bubble burst. Actually, Buffett had underperformed by that time the market by probably around 60% in just a year and a half. But he stuck to his guns, he stuck to his investment process. And I think the rest of the story is well known by all. Actually, I mean, if you think about it, Buffett's underperformance was not coming from a permanent loss of capital, but just from a market headwind. I mean, the market was wrongly pricing the stocks in his portfolio, and also wrongly pricing the stocks that were not in his portfolio, you know, with the benchmarks going up and up without in general, a fundamental justification for it. So to us, it's critical that the manager doesn't capitulate for the wrong reasons, that he or she doesn't change the investment process in the middle of the game. We want them to be, you know, consistent in applying their investment style, their investment process. And then going back to the late 90s, in the next 3 years after the tech bubble burst in March 2000, those investors, and actually the managers we have in our fund as well, by the way, they all delivered positive returns, you know, in the order of 20, 30, 40% in some cases, while the market was down 40, 50%, or the Nasdaq even down, I think 75%, you know. And, you know, I believe the current environment has some similarities to the late 90s. You know, there are these two firms in the US, GMO and AQR, which I'm sure many viewers know about, that they measure the divergence between expensive and cheap stocks in the market according to what they call the value factor. And we've now gone through a decade up until recently where expensive stocks had massively outperformed cheap stocks, taking that divergence of cheap versus expensive to an extreme level. That divergence is true that has started to narrow in the last probably 18 months now, but it's still at a level only seen before in 1999. No, so we insist in the concept of paying a lot of attention to valuation. We think that's critical in order to have like a large margin of safety. And then, you know, and wrapping up the answer to your question, Itai, in that regard, we are not really concerned by the underperformance from a manager that has had a strong market headwind, but we do want to see that there were no big mistakes, no large permanent losses of capital, and also that the manager didn't capitulate and, you know, kept applying the same investment process that he or she has applied, you know, over the last 2 or 3 decades. Because, you know, at the end of the day, market headwinds or tailwinds come and go, and short-term performance is driven more by luck than a skill sometimes. And we think, we truly believe that what drives long-term performance is, you know, the manager's hard work, their talent, their process, their patience, and of course having the right temperament.
Yeah, I think that makes a lot of sense. And what are you looking for in college students who hope to one day work at Asvalor?
Okay, that's a good one. I could probably answer the question, you know, focusing on the technical skills like, you know, accounting, economics, math, that, you know, I think are certainly required in order to work at probably any investment firm in the world. But I probably emphasize something more intangible, which is, you know, to me, temperament and passion. I mean, as any job, an investing role has pros and cons. There's obviously a lot of pressure, long working hours, very hard work involved, a lot of competition from very smart people around the world. So you, in my view, you really need to love investing and love in capital letters. I mean, you need to enjoy the process and not only the outcome, enjoy the journey in a way. Otherwise, I think it's really impossible to succeed. I mean, if you think about many of the greatest, most successful investors in history, actually never retired, or, you know, retired money, outside money to just run their own money. I mean, they just love what they do. They, if I had to do an analogy, say you're a student at Brown University and you play in the basketball team, you know, if one day you want to become a professional player, you really need to work hard. I mean, probably spend hundreds or thousands of hours practicing. You really need to go the extra mile, because there are going to be others, you know, or many others in the world trying to get that place. And if you don't give your best, you will fail basically. And so you really need to love the game. If not, it will not work in the long term. It may work for a few years, for a short time period, but if you are really thinking long term, you really need the passion, right? And I think this concept applies both for basketball or any activity you do in your life, and of course investing.
Yeah, absolutely. Javier, thank you so much for that commentary. It's very valuable, and we really appreciate you being here today. And
Thank you so much.
Absolutely. And Adam, feel free to begin with your presentation when you're ready.
Okay, well, thank you so much for having me this morning. The same as Javier said, it's a real honor to be here and really excited to talk to you all. Incidentally, my wife went to Brown. She was a graduate of Brown in 2009. So, the university holds a special place for our family. And we actually met when she was still a student in university. So I have very many fond memories of going up to Brown and spending time on the beautiful campuses and everything of that nature. So really happy to be here today and to talk to you all, and happy to be here talking alongside Asvalor and Javier, because there's few people that we hold in such high regard as the team over there, and we could talk about all the reasons why. But let me tell you that, many of the things that Javier spoke about in his presentation just now, a lot of investors try to just, speak out, say, oh, we're trying to be real deep value and have a margin of safety. And when the going gets tough, we really try to stick to our guns and whatever. But there's very, very, very few investors that can actually do it. And that's something that we'll talk about today, because I really think that that's a big part of what it means to be a true value investor. And the team at Asvalor, for all the reasons that Javier talked about, is exactly that team. And they're very rare to find. But we were the perfect example of a manager that did underperform immediately upon having been added to that portfolio. It was a market headwind. We did stick to our guns, and through a lot of very careful communication and transparency, I think we were able to help the team there make the right decision. But a huge amount of respect for their team for really being true value investors, of which there's almost none in the world today. So I'll give you a little bit of background about who we are, what we like to do, some of our investment philosophies and our history, and then I'll leave as much time for questions as possible, because I think that's really interesting. So we're natural resource equity investors. That's all that we do. We invest exclusively in public traded equities of commodity producing companies and all the companies related to them. So that would be, energy, materials, metals and mining, grain and agriculture, shipping, oil services, uranium. We can talk about all those different markets today, because for a long time, nobody had any interest in talking about them. And now they seem to be very, very on the front of everyone's mind. So we can talk all about that. We're value investors. We're deep value investors. We could talk about how we implement value strategies in the portfolio. But as you might suspect, with the exception, as Javier said, of the last 18 months, to be a deep value contrarian investor with a natural resource focus, we haven't had a lot of friends in the last number of years. And that is a great indication that the market was offering tremendous value. And we could talk about where we see value today, because one of the biggest questions that we get asked today is whether or not we've missed this move. And we've tried to lay out some roadmaps and some indicators and some financial metrics that we can look at, not only now that show us that, no, we're just starting, but down the road that'll be able to hopefully say, okay, look, I think that this market has now run, we're fair valued, and then eventually probably we're overvalued. And one of the things I'll say, about Javier and the team at Asvalor, the first night that we all had dinner together, we had a wonderful dinner and we spoke, we got to know one another. And at the end, they said, we're really, really disappointed that one day we're going to have to say goodbye to you guys, because eventually everyone's going to realize that natural resources need more capital and prices are going to go from radically undervalued to radically overvalued. And that'll be the hardest thing we do. And I think that that's so important, this idea of self-discipline in a true value approach. My partner, Lee, started managing resource equity in 1991. He started all the way back with Prudential, and he ran all of the Prudential, and then Prudential merged its mutual fund business in with Jennison, so it became the Prudential Jennison Natural Resources Fund from 1991 to 2005. It was a multi-billion-dollar fund at its peak. In 2005, he was approached by Richard Chilton of Chilton Investment Company, which is a large hedge fund complex here in New York City, and was asked to start a global natural resource strategy at Chilton. So we did that in 2005. Had a fantastic track record, both at Prudential Jennison, had the best track record of any resource fund manager in the world. At Chilton as well, knocked the cover off the ball, so to speak, from 2005 when he started there, all the way about till 2011, 2012. And at that point, some of your viewers might remember, some might not, the natural resource equities entered into a pretty bad bear market, and that bear market basically ended only last year or the year before. So a pretty severe, dramatic bear market that saw valuations collapse or stock prices collapse 90%, valuations sometimes by 100%, as those companies just sort of plummeted in value over that time. From 2012, when that bear market took hold, to 2015, we didn't do great. We didn't do terribly. We were sort of in a period of time where we were in line with most of our peers. The absolute market in our sector was down over that period, and so we were down as well. We didn't, have any huge mistakes. There's obviously things you look back on and say, oh, I wish we didn't have as much gold exposure. I wish we didn't have exposure to coal stocks, but there wasn't anything that was sort of catastrophic. It was really a pretty major market headwind. And by 2015, Lee and I sat down and spoke. And as I think most value investors know, when you have a period of underperformance, that really becomes a moment of turning inwards and sort of soul searching and of, updating the models 3 times a week and of, really double checking everything and making sure you're right, because you want to know that you have your courage of conviction to be able to maintain those positions when they're moving against you. And it's very, very difficult. Obviously, in retrospect, it's easy to say, oh, we held in after everything turns positive again. But in those moments, it's really a period of time of, I think, going back to basics and making sure you're comfortable with all your theses and really, getting in quite deep with your names and with your macro views. And so we did that. And by 2015, we said, look, the value that's present in this market today is really unprecedented. And when you look back, we can talk about 2 of the metrics we like to use. When you look back, by the end of 2015, 2016, the value that was accruing in the space was truly, truly at historic levels. And so we made the decision at that point. We said, look, let's start our own firm. Let's dedicate ourselves just to the long side, because in the Chilton days, we were operating long short. Let's just look on the long side of things. We felt that that's where all of our value was being added. And if you looked quantitatively, that was really true. Let's take our fees down. And so we'll get rid of the 2 and 20 style hedge fund fee structure, and we'll just do a straight 1% management fee. We'll deliver all of our value approach on the long side, and we'll offer it in a way that's easy for investors to invest in. So we have a mutual fund in the US. We have separate accounts for international investors, of which As Valor is one. But in the US, and all the strategies are managed the same, but in the US, we have daily liquidity. It's plain vanilla. It's low cost. There's no sales carry or anything like that. So we wanted to make it as straightforward and easy as possible for investors to get exposure to resource markets. And we felt that it was a perfect value contrarian time to do that at the end of 2015. And in retrospect, part of our philosophy, and you'll see why and when we start talking about different markets, sometimes we're wrong. Anytime you're contrarian and different from the market, you run the risk of being wrong. And obviously we're wrong sometimes, but a lot of the times we're early. And I think even in starting the firm, we were a little bit early in the sense that, we really felt that the inflection point was coming in 2016. And, here we are, and it seems to really have been sort of late 2020 when things got going. Now, of course, we couldn't have foreseen COVID back then. And so maybe it would have happened a little bit earlier, but in any event, we started in Jan 1, 2016. We operated for 12 months as a family office. We had a non-compete, and then we opened ourselves up to the public in 2017. We're 100% manager owned. We have about $350 million under management today. So we're not as big, certainly, as we used to be. However, I should point out that the amount of capital coming into this industry has been almost nothing, even with this price movement. And I think that's so important, because when you look at how far these stocks can go and what's been driving them, many of these stocks are up 200-300% off the bottom, and people say, well, how can they still represent value? And we can talk about on all the different valuation metrics that we're looking at. Actually, because the commodity prices have been moving higher, they offer more value today probably than they did back a year or two ago, depending on how you want to look at them. But what's really important from a stock price perspective, it's just that there's been no capital put to work in this space yet. And so it still is super out of favor. If you look over the last 100 years, energy has averaged between 12 and 15% of the market. Over the last 30 or 40 years is closer to 10%. It got it at peak in 1980, it got to be 30% of the market. That's incredible when you think about it. And at its lows, it was less than 2% of the market last year in 2020. So today, here we are, we're 3.8% of the S&P 500 by market cap today. So we're still, a factor of 2 or 3 below average, let alone, radically overvalued. But what's been more impressive is that move has happened with almost no institutional capital flow. So if you look at, for instance, money coming into the different funds and into the different ETFs, there's been the XOP, which tracks the E&P universe, so the exploration and production, the oil and gas company universe, since the beginning of 2021 has seen no net inflows. Okay, that's incredible given the price performance of those stocks. We were up 60% last year. We're up 40% again in the first quarter of this year. So I mean, these are big moves, but they're happening on no money being put to work. What happens when people begin to shift the portfolios a little bit? What happens when people begin to shift their asset allocations a little bit? We haven't seen it. It's sort of been the mirror image. I'm sure many of your listeners will know that, Cathie Wood's ARK fund, which has sort of been the poster child for the momentum FANG trade of the last really decade, even though it's down 40% year to date, it's seen net inflows so far. Even more recently, the Wall Street Journal today that Cathie Wood is starting to see inflows into her fund again, and so you look at the price action, and that's with no forced selling of those stocks for redemptions. And you look at the price action on some of our stocks, that's been with no net buying yet. So this bull market has a long way to run, and what it really comes down to is the fact that things got so out of favor for so long that the capital cycle was really hurt badly. Nobody put money to work. Nobody invested in their mines. Nobody invested in their oil fields at a time when demand was actually very strong. So like I said, we're value investors. We think that the best time to find value in the commodity markets is when investors are neglecting the space, when they've looked away, when capital is very tight, when the price of the commodity is low. And so oftentimes companies might have little to no profitability. So you say, well, how can you be value investors? We have to look at different things. So either look at things on a price to book basis or on a price to NAV basis using your longer term sustainable view of the commodity price. We love it when commodities get unsustainably low. And that term, I suppose you only know it in retrospect. But what do we mean unsustainably low? What we mean is that if the commodity price were to persist, the industry would stop ceasing to exist in 3 to 5 years. And so obviously when oil prices got to $20, that's an unsustainable oil price, because if you keep oil at 20, you won't have an oil industry. Gold in the late 1990s got as low as $250 an ounce. The average cash cost was $325. You wouldn't have a gold industry if gold prices stayed at that level. And so that's where we try to really roll up our sleeves and do a tremendous amount of fundamental research. We try to dig in at the commodity level, trying to understand if those supply and demand trends are beginning to shift to be more positive, because investors become unbelievably focused on the trends that are in place, and they tend to extrapolate those trends too far, whereas we tend to look for the turning points. And I know it sort of sounds, it sounds silly to say, but we've done a pretty good job over the last 30 years of being able to identify those turning points long before our competitors do. Like the team at Asvalor, we're completely index agnostic. We obviously have to use indices because people want to benchmark us against something, but we really build the portfolio based on themes the way we see it and where we see value today. And once we've identified the sectors we want to be in, we build bottoms up stock selection models for everything that we look at. And what we're basically looking for are names that, if we're right on the commodity price movement, we'll have a strong exposure to that commodity price change. However, if we're wrong, as Javier was talking about, you won't permanently impair that capital. I completely agree that risk and volatility really don't go hand in hand. And frankly, if you can find a name that exhibits a lot of volatility, but has little risk of permanently impairing capital, the market will probably pay you an above average rate of return to own that security. And that's a great way, I think, to invest in the long term, because I think that that's a fundamental mispricing of security value. To me, the idea is, if we're wrong on the commodity price, or if we're early on the commodity price, will we permanently impair that capital? So if we're completely wrong on the oil price, our oil stocks won't do well. But I'll give you a great example. We could talk about it later if you'd like. Pioneer Natural Resources, when oil prices went negative in the spring of 2020, we modeled that company out 4 or 5 years quarterly based on a $20 oil price. Now, keep in mind, at $20, Pioneer would be the last oil company operating on Earth. Nobody would be able to survive. And Pioneer, I think, got to about 1.5 times net debt to EBITDA. We said, okay, there's very little risk here that you're going to permanently impair capital. But you still had strong upside exposure, several fold at that point. And so to us, that was a great investment, a core holding in the portfolio. A little bit different than perhaps some other value investors or than the team at Asvalor. We're probably a little bit more diversified in our holdings. We tend to own about 50 to 60 names in the portfolio. And it's not that I don't think concentration is important, but I think that there is a reality that with resource stocks, whether you're talking about mining stocks or oil stocks, there is more idiosyncratic risks. You can have things like pit walls collapsing or tailings dams collapsing or, unexpected water incursion into your mines or into your oil fields and things of that nature. And so I think we've always been more comfortable being a little bit more diversified. A core position for us is between about 5 and 7% of the portfolio. Then if the name has a little bit more risk, we won't stay away. We'll just own it smaller, maybe 2 to 3%. And then we have a few names. I know they drive Javier crazy because he has to explain them to investors, but they're less than 1% each. And, they represent sort of the big upside potential, but they're really risky. And in some cases, they could be binary. These are earlier stage mining exploration names and things of that nature. We've done a lot of work. We really like the management team. Our understanding of the geology is really promising. But objectively speaking, no cash flow yet, and a lot could go wrong. And so we'll own it, but we'll own it in a much smaller, more diversified kind of basket approach. And that's really the way we've operated for a long time. Lee's track record over his career has been excellent since inception, which was in 1991. He's averaged net of all fees, including all of the expensive hedge fund fees. He's averaged just under 9.9%, which beats our peer group by about 200 basis points per year and is in line with the S&P, even though resources have been in a bear market, most of that time. And over the last 5 years or 6 years, we've returned 15% against our benchmark of 10.5%. So the numbers have been very, very strong. But as I alluded to before, there's been periods of strong underperformance along the way. And that's just sort of the cost of doing business as far as our strategy goes. We try to maintain a lean operation to deal with that. We try to maintain a huge amount of transparency. We write these very detailed quarterly letters that we put available to the public. They're about 30 to 40 pages long. I'm going to spend the rest of the day working on that today after we get off here. And that's really meant so that our partners can really understand how we're developing our views, how we're developing our positions. And in the event that the market turns against us for a period of time, like it did in the last couple of years, they can more confidently understand why we're underperforming and make the decision as to whether or not they want to hopefully stay with us or not. So that's us in a nutshell. And I'll stop now and we can talk about whatever questions you have.
Yeah, sounds terrific. Thank you so much for that commentary. It's very insightful. And let's start with what metal commodities and what non-metal commodities look most interesting to you today?
Well, I think the most interesting thing today remains the energy complex, and most notably natural gas. Now, depending on where your listeners are tuning in from today, they'll be more or less aware of the sort of energy crisis that's unfolding in Europe and in Asia. That energy crisis is very acute, and in the United States, we're a little bit insulated from it, and I'll tell you why that is. We would have said that the energy crisis would have started in oil and spilled over to natural gas, and in retrospect, it was sort of the opposite. It actually started in natural gas and spilled over to oil. And I want to clear up one thing that I think is really important today in particular. Most people, I think, equate the current energy crisis with the actions in Russia and their invasion of the Ukraine. But you have to keep in mind that this energy market was in a bull market long before that. The underlying drivers of why we're in a bull market have nothing to do with the current hostilities. And what they've served to do is make everything worse. They've been the catalyst, I think, to bring this to people's minds. But in the event that we do have a de-escalation, which I have no insight into whether I think we will or won't, but it's not going to solve the energy crisis. We've underinvested in this industry now for 10 years. And so one of two things has to happen. Either the capital that we invest has to become much more productive, so we find and develop more oil with every dollar spent, oil and gas. And I can tell you that is not happening. If anything, it's exactly the opposite. We're running out of our best areas in the shale. We don't have anything to follow them up with. And so we're seeing a decrease in drilling productivity. Or secondly, we have to spend more money. And not only do we have to spend more money compared to what we're spending today, but we have to spend a lot more in order to catch up for the basically $1 trillion we've underinvested in the last decade or so. And there's only one way to do that. You need to attract that capital back. And that'll be with strong returns. We're not seeing any of that happening, even though the prices are up. We're seeing no capital being put to work. We're seeing very little in the way of increased drilling budgets and things of that nature. Now, for a whole variety of reasons, owing to a cold winter 2 years ago, and both in Russia and in Europe, we started to develop, long before Russia and the Ukraine, a natural gas supply shortage in the summer of 2021. And by the fall, Europe was trying to refill its inventories ahead of winter, and they realized that they weren't going to make it. So gas prices almost overnight snapped, and they moved much, much higher. So from an average, they got as low during COVID, seaborne LNG, which is liquefied natural gas transported by boat, got as low as $2, which is amazing at the depths of COVID, but let's say $5, $6, $7 more realistically. They snapped to as high as $50 per MCF in Europe and in Asia. Just to put that in perspective, $30 multiplied by 6, it's $180 oil barrel equivalent. 500 times 6 is $300 per barrel oil equivalent. Okay, so this is a massive, massive, massive energy price. It's starting to have a huge impact already. We're starting to see factories shut, fertilizer plants shut. But here in the United States, gas, even with the recent run up in gas prices, gas prices now are still, between $6 and $7. Last fall, they were as low as $3.54. So you had a global price of 50, and you had, a $4 US gas price. Like, how could that be? And the reason is that the United States, when it comes to its gas market, is basically an island. And so we produce a lot of gas here. We used to import gas. So we have facilities set up to import gas by pipeline from Canada. And then we used to have actually LNG imports, which is amazing. And you'll understand why. In fact, going back about 10 or 15 years ago, I think we were the 3rd or 4th largest LNG importer in the world. And then we discovered the shales. And so we had this huge doubling of US production. The shales ramped up. It was the most dramatic ramp up in a single gas field in history. And we went from being the world's 3rd or 4th largest importing country to the world's largest exporting country. So now we export 13 Bs a day by the end of this year of natural gas in the form of LNG. But we're still in a structural oversupplied market, or we have been in the US. And that's why, on an international basis, you still have $30 gas prices. Here in the US, you have between 6 and 7. So if you get that gas to an LNG facility, you liquefy it for $3 is 10, you ship it for another 1 or 2. You're talking about selling a product for between $30 and $50 and your total cost to get it there is between 10 and 12. There's a huge margin, but we're capped out in terms of our LNG export. And that's why the US price is dislocated from the rest of the world. What happens if we're unable to supply the incremental new 2 BCF a day of LNG coming online this year? What happens if the shales begin to slow and even potentially turn negative? What would happen is you would no longer decouple from the rest of the world. You would effectively have more LNG export capacity than you have gas to feed it. And your relative price between the US and the rest of the world would converge almost instantly. And so you could see a tripling or quadrupling of gas prices in a matter of months. And I think that is probably the biggest unexpected shock awaiting resource markets potentially in the next 12 months. So we're doing a lot of work now on whether or not the depletion problem in the gas shales is real. You have to remember, over the last 10 years, natural gas supply in the US has been driven basically by 3 fields: the Marcellus, the Haynesville, and the Permian. The Permian is actually an oil field, but it produces gas too. We're seeing much less growth there than we've seen in the past. So that leaves basically the Marcellus and the Haynesville as the major source of growth. And we think that those fields are approaching midlife, basically. So they're not going to necessarily collapse, but we're not going to get incremental growth from there. And so that could be a real shock that people aren't waiting. So I think as far as one market in particular, that could be the most unanticipated, interesting market in the next 12 months.
And speak as well about maybe coal and oil, and also your thesis for Range Resources and Pioneer Natural Resources.
Sure. So as far as coal and oil, and those are 2 really interesting markets, and we can talk about a little bit of a difference between those 2 markets. We've invested heavily in oil. We've not invested so much or at all in coal. We used to be major coal investors last cycle. We have not, although it's something that we're thinking about and considering. Now, the only problem is the names have moved. They're pulling back here with the rest of the energy complex. So maybe they're becoming interesting. As value investors, we hate to buy something after it's moved. Although if there's still value, maybe it's the right thing to do. But it's just kind of, gnaws at us a little bit to buy something after it's had a big move higher or establish a position in it. But the reason that we have liked oil and we don't like coal, there's a lot of similarities between the two. They've seen massive price collapses. They don't have capital available to those industries because of ESG pressures and a lot of sort of, dictates and mandates at the institutional level to avoid them. That's always a great sign for a value investor. They've both been called uninvestable, which is a wonderful sign for a value investor and a contrarian investor. Valuations are cheap. If you put in a long-term sustainable commodity price to keep that industry afloat, both sets of companies offer tremendous valuation, probably coal stocks, I would say even more than oil stocks, but oil does too. And they both have suffered from huge capital, like I said, underinvestments over the last decade. So why have we favored oil stocks and why haven't we favored coal stocks? In the lead up to the last 12 months, the reason has been pretty simple. When we look at the world and when we look at investors' appetite for energy vis-a-vis carbon emissions and things of that nature, we're looking for energy efficiency on one axis. And I think this has been the big problem. People have said we want green technologies, but they don't realize how energy inefficient they all are. And we don't think it's long-term viable or tenable to try to build an energy base on something that's low carbon, but extremely low energy efficiency. So what we're looking for is something that would be very energy efficient and low in carbon. I think that would be attractive to people's tastes today. Uranium and nuclear power, which we can talk about, fits that bill. It has wonderful, what we call energetics or energy return on energy invested. And renewables has terrible energetics. And so to us, that's really never been a viable long-term option. When you look at crude oil, and you particularly look at gasoline and diesel to power motor vehicles, if you look at the total amount of energy to move somebody a mile in a fuel efficient car versus in an EV, once you've properly accounted for that EV's lithium ion battery, and you assume that that's going to be powered with wind and solar power, because if you power it with coal or gas, you might as well just drive the gasoline or diesel car in the first place. And you then factor in the battery backup for the wind and solar in order to keep the whole system running. It requires, we estimate, about 50% more energy per mile driven or per kilometer driven for Javier than an internal combustion engine. And so for us, that has been just a huge impediment to widespread adoption of electric vehicles. And to us, that means that there's really very little alternative to crude oil and to gasoline. And so it's been a perfect setup for us. We say, look, we really see very strong demand. We don't see any feasible alternative. The energy return on energy invested in crude remains very, very strong. Price is low. It's been underinvested in, and valuations are low. With coal, over the long term, there is a theoretical substitute for coal, and that's natural gas. And so if you look, natural gas enjoys the same energy return on energy invested as coal. However, it emits half the amount of CO2 per unit of energy. And so to us, that's always been a concern about coal over the long term. We say, look, you could theoretically move away from coal towards natural gas. You're not going to be having a huge reduction in your energy efficiency. You're going to be reducing carbon. And to the extent that we want to be addressing, not we as investors necessarily, because I don't know that that's the appropriate role for the investor to play, but as a society want to be curbing carbon emissions, I do think that natural gas is an extremely valuable bridge fuel. However, and this is where things change, we are now very, very clearly in an acute gas crisis. And so to say, look, coal has this feasible alternative, natural gas, is sort of like missing the forest for the trees, when around the world, everyone is shutting down their factories and shutting down their fertilizer plants because there's simply not enough natural gas available. So right now, I don't think there is an alternative to coal. And that now means that coal investments could potentially look interesting for us as sort of more medium and longer term investments, because we simply don't have enough natural gas. One point that I would make, and this is probably the most important point of all, I should have started with it. In every commodity bull market over the last 120 years, coal stocks have been the best performing subsector from trough to peak over every single one of those bull markets. And this time will probably not be any different. So I think that we're slowly, beginning to warm to coal. Like I said, we're looking for a more attractive entry point, but we might be getting awfully near to that right now.
Yeah, absolutely. And you commented a little bit on uranium, and maybe discuss a bit more about uranium and also your thesis for Kazatomprom and Chemical.
Oh yeah, sure. Oh, and I didn't talk about the names. I'm sorry. You wanted to know about you wanted to know about Pioneer and Range Resources.
Yes.
So
exactly.
look, Range Resources has been our #1 gas name for quite some time. We bought that position. We increased our natural gas exposure dramatically in 2020. I have to go back and look exactly when we first established our Range Resources, but we added to it dramatically in the spring and summer of 2020. At the depths of COVID on March 11th, they got as low as $1.94. Today the stock's 30. Okay, so we'll talk about value and how does that all play in. What's amazing to us about Range, and Range has had a controversial past. So, it has some hair on it going back, 10 years, but that's all long behind it at this point. But investors loved to stay away from Range Resources. In fact, I remember I went to a dinner with a hedge fund investor, and he said, you make this energy investing way too complicated. You write these big letters and you have to do all this research. He said, it's quite easy. I just come in every morning and I short Range Resources and I go home, and that's all you have to do. And that was really the mantra. I think the short interest in the stock got as high as 35%. And there's a view that they were potentially going bankrupt. They control the best undrilled acreage location in the southwest of the Marcellus, which is probably the best gas asset in the whole world at this point. Their big competitor on the northeast side of the field was Cabot Oil and Gas. However, the big difference between Range and Cabot was that Range still has a big drilling inventory of high quality tier 1 wells left to drill, and Cabot didn't. Our research uncovered that quite early, actually, which is why we always stayed away from Cabot. And now Cabot has moved completely out of the basin. They made a Permian acquisition, basically confirming the fact that they don't have a huge amount of high quality drilling inventory left in the Marcellus, but Range does. The Marcellus, it makes the best gas wells in the world. They're extremely economic. The problem, like we said before, is that we think that there's not as much drilling inventory left there as people might widely believe. But when you look at Range today at 30, and you take a look at its SEC PV10 value. So what that is if you look at their 10K, every year, every gas company needs to manufacture what's called its PV10, which is its proved reserve. So only its highest conviction reserves, something that has over a 90% chance of being produced, that's known as the proved reserve. You use the average monthly ending price. So use $3.80, in terms of, that's what was used in the 2021 report. No upside potential, no what they call probable reserves, no future expanded drilling, just basically what is currently in the drill plan. And you put a valuation on that, you're talking about something that's in the order of magnitude of $35 or $40 per share right now. If you put $5 gas in, you're at $70 or $80 a share. And if you put today's gas price, which is, let's get you the most current since everything's moving, $6.60, you're over $100 a share, right? So here you have a stock that bottomed at $1.91. Today, it's not even pricing in last year's gas prices. Pre-crisis, not even pre-Russia-Ukraine, just pre-energy crisis at all, because you're taking the month end of every month last year, right? So $3.80 gas. People are going to look back on this and say, well, that was just foolish and ridiculous. When it got to $1.91, mind you, if you use $2 natural gas price and you assume that Range would never drill another well again, I think the stock had like 50 or 60% upside. We've never seen values like that in the commodity space. Typically, you have to take that SEC PV10 value, and as an investor, you have to pay a multiple of that to reflect the future growth opportunities. And what really becomes the key issue is, how do you value that upside? Here, you don't have to do any of that. Basically, if they don't drill another well today and gas prices stay where they are, the stock's a buy. And here you have the premier gas asset in a commodity that's undergoing a global energy crisis focused on that commodity, which is natural gas. It's just completely being overlooked. People just don't understand it. People say, well, maybe we missed it. And I understand that, when a stock goes from 2 to 30, you get that. However, the value today, I could argue is just as great based on its PV10 value than it was almost at the depths of 2020. You were asking about uranium. So again, when you look back, we became involved in the uranium markets several times over the last 2 decades. We traded the uranium markets very, very well, or Lee did rather, from the late 1990s all the way to the peak in 2008. Uranium prices went from $9 a pound to $150 a pound, and uranium producing stocks, of which there's very few, were very, very strong. Some of them were the best performing stocks over that time. It created a huge uranium exploration boom and a huge amount of M&A activity, which are typically usually signs that, to stay away as a value investor. And what's interesting is none of those exploration projects ever came online. None of them were developed. And so you basically have this market where you still have a duopoly with Cameco and Kazatomprom are basically the only two producing companies, primary uranium producing companies in the world. 2008, uranium prices collapsed in the global financial crisis. They started to rebound again in 2011, and then Fukushima happened, and uranium prices and the stocks fell dramatically, 30, 40% in a matter of a day or two. We actually established positions in the uranium producers then, and that was a mistake because in retrospect, what you were about to undergo was a huge period of nuclear power plant decommissionings. Japan kept its nuclear power plants down much longer. They're still down today. Germany decommissioned nearly all of its nuclear power. Germany was a huge consumer of nuclear power. They decommissioned all of theirs. And really nothing new was sanctioned anywhere in the world outside of China. Uranium prices fell to as low as $18 a pound. And at $18 a pound, we talk about unsustainably low. That was actually below the cash cost of operation in a duopoly market where you only had two producers and the entire market had consolidated and everyone else was out of business. Talk about an unsustainable market. Usually, if you look at the commodity cost curve, if you get prices down within the 90th percentile of that commodity cash cost curve, that's usually a bottom. Now you went through all of it. You went through the entire cash cost curve. And there's reasons for that. Uranium is a bit of a funny market. The fuel cycle lasts 3 years, so you can get supply and demand out of whack. But clearly, we felt that was an unsustainable market. Cameco and Kazatomprom both announced supply curtailments in 2018, and that's where we became excited. We said, look, we think this market's actually turning positive. Our view was based on China and India building out fairly large new reactor build programs, and the fact that from the supply side, things were extremely tight because no one had built a new mine, and the people that did have existing mines were shutting down and curtailing their production from those mines. We viewed that the market would likely turn somewhere around 2022, and so and then that was pulled forward because Cameco announced the closure of their flagship operation to about 2020. So we established our positions early, like always, in late 2018, early 2019. Today, we're on the verge, I think, of a major nuclear power renaissance boom, the likes of which we haven't really seen for nearly 2 decades, probably. And the reason for that is the other benefit of nuclear power, which is it is far and away the most efficient way to create electricity. For every unit of power that you put in to a coal plant to mine the coal, process the coal, build coal plants, and dispatch the power, you generate 30 usable units of energy. Natural gas is about the same, so about 26 or 27. Renewables are about 5. So for every unit you put in, you get 5 units out the other side. So it's terrible compared to hydrocarbons, but it emits no CO2, presumably, at source, even though you have to make all the steel and cement. Uranium, for 1 unit in, you get 100 units out. The last time that we've seen a step change, if we were to move to nuclear, would have been when we went from burning wood in the 17th century to burning coal, which had a huge impact on the planet and on prosperity and on longevity. I think that could be the type of thing that we're looking at now. If we actually can get through this and can change our views on the perceived safety problems of uranium and nuclear power, of which it's an extremely safe source of electricity, by far the safest on any metric you look at, we could conceivably be harnessing a source of power that's super, super, super energy efficient. And that's going to lead directly to increased prosperity and GDP and longevity and things like that, which is exactly what we need right now. So we really like it for the short term because of its supply and demand trends. And we really, really like nuclear power for the long term because of its ability to generate power very, very efficiently.
So what about all these projects that are right now offline? Are you concerned in the long term that if prices are fairly high, a lot of these projects will come back online and will come online essentially and will flood the market with supply?
So I think what's been interesting, both Cameco and Kazatomprom, that's been a bit of an overhang on the market over the last couple of years, is what's going to happen when they restart these shut down mining operations. What's interesting is that the hope has always been that Cameco would announce that they would restart their shutdown mine on the back of long-term contracts against that production. So effectively take it off the market. Now that's not really true, right? Because everyone has demand modeled. And so you take that demand off the market and the supply, but at least it would be matched. It wouldn't flood the spot market. It wouldn't flood the market and depress prices necessarily. And that's exactly what they did. So I think that is behind us now to some degree. And I think that everyone in the market was quite relieved to see that they had done that in a fairly disciplined manner. So, I think the real issue here is that not a single mine has been developed or brought online in 20 years now. And so, yes, you can, anytime you have curtailed production, that can come back on. But the bigger issue here is the fact that we just haven't invested in this industry in a really long time.
Yeah, I think that makes a lot of sense. And let's transition to talking about copper and your thoughts on copper, and also about Copper Mountain Mining Corporation. Full disclosure, by the way, I own that, obviously not investing advice, and also about Amerigo.
As far as copper goes, what's really interesting about copper when you look at all the different commodity markets, and this is as of about 2 years ago, I guess, but it's just as true today. When you look at all the different commodity markets, and you talk about which one is going to be successful and which one is going to go up in price, there's really, you sort of think that we're all talking about the same thing, but there's different ways to really define what that means. And one could be, what's the highest probability it'll go up? What is the risk-adjusted probability it'll go up by a certain amount? What have you. And all of those, and the dispersion of outcomes and stuff like that, all of those are important. What's interesting about copper is that copper, under almost any scenario, will go up and enter a bull market over the next 10 years. And the reason I say that is copper mines tend to have about a 10-year lead time in terms of major copper, from making discovery to booking reserves to building the mine to production. So you can look back and kind of see what's coming through the cycle now. And seriously, I mean, it's quite daunting. New copper mine discoveries of large copper deposits went to zero for a period of time. I mean, that has never happened in the history of the copper industry. So we've just been extremely bad at finding new large-scale copper mines. And the existing mines that we have are all suffering from depletion problems. So people talk about, Grasberg Underground, which we visited Grasberg a number of years ago. Grasberg's the largest copper and gold mine in the world in Indonesia. They say Grasberg Underground is coming online. Yeah, that's true, but it's replacing Grasberg open pit, which is now fully depleted. So it's basically, net zero. Oyu Tolgoi in Mongolia is coming online. First of all, it's like 10 years delayed, and they're suffering major geotechnical problems and issues. And so, yes, it will come on, and it is in everyone's model, but it's simply not enough. We're running a really, really, really substandard supply base at this point. And secondly, when you look at the electrical properties of copper, the fact that it's very efficient at conducting electricity, there's really very little replacement and substitute, and so people use aluminum for long distance power lines and high voltage and things like that. But that displacement's already happened. You could displace copper out of your homes for pipes and roofing, but that's all happened. No how homes, new homes or new construction or renovations use copper pipes anymore, and very few, if any, use copper roofs. But as far as electricity, particularly in distribution, which is to say off, in the neighborhood from the high tension power line into the homes, you have to use copper. There's nothing else that'll do it. If you look at a transformer, which takes high voltage power and transforms it to low voltage power, those sort of substations in your neighborhood, that is a giant spool of copper. That's sort of almost all it is. And as you look to see countries electrify, which is to say huge parts of India and huge parts of China increase their electricity consumption, and then you look to say, okay, look, whether renewables happen or not, there's going to be a huge amount of demand coming. Then if you layer in renewables and or electric vehicles, that just takes it like a huge step higher. And so, when we look at some of these ideas, we say, okay, we have a very high conviction that renewables won't work. And we're not investing, in renewable companies. We're not investing in battery metals because I think they're very, very challenged for all the reasons we talked about. But with copper, you don't need those things to happen to make copper work. And if we end up being wrong about any of those, copper will benefit massively from that. So almost in any world that we look at here going forward, renewable, not renewable, EV, internal combustion, you start to see a huge demand supply structural deficit over the next decade in terms of copper. That's why we like copper. Now, we have sold a little bit of our copper exposure over the last year, and the reason has to do with what I talked about before in terms of value. We actually did see money move into the copper space, which we've not seen in the energy space. We haven't seen it in the gold space. We haven't seen it in the coal space. We haven't seen it really in any other commodity markets, but institutional investors did move money into copper names. And so we saw some of those names run, fairly dramatically. Still didn't get to our price targets based on where we think the equilibrium price is for copper, but that has real money moving behind it. And so I do think from a true value contrarian approach, you're somewhere along that path already. And so we've been using that, not that we've been selling out of those names because we're bearish on them, but we have been using them as sources of proceeds if we wanted to increase our energy exposure, if we wanted to increase our agricultural exposure, et cetera. So as far as Copper Mountain goes, Copper Mountain has, the Copper Mountain mining district in BC in Canada. It's a 75% interest along with Mitsubishi. It's a big copper gold porphyry, huge 31-year life of mine. I'm trying to look here on, our price targets, the stock, based on 100 million pounds and $1.70 all-in sustaining cost over the next 30 years and a really de minimis capex budget, like $60 million in incremental capital. Its potential enterprise value is in the order of magnitude just on that one project of over $2 billion. I'm just going to see where the stock is today. Hang on, bear with me. The enterprise value even after this run is like $950 million Canadian, and that's using like a $4.50 copper price. If you use a $5-6 copper price, then the value of this asset is really, really dramatic. So if you start to look at kind of the larger, newer copper discoveries and development projects out there, you have Kamoa-Kakula, which is the huge Ivanhoe asset in the DRC. We own that. And Copper Mountain is a big one as well. Another interesting one that we visited but never owned, has a lot of potential challenges to it, would be the Timok deposit in Serbia. But that's like a kilometer underground. It's a big porphyry, relatively high grade, but incredibly deep, incredibly complicated. Unfortunately, I think that's kind of the next generation of copper mines out there. They're not going to be the same, and they're not going to have the same economics that we've enjoyed in the past.
And speak a little bit about Amerigo as well, please.
Amerigo is a really interesting name. Amerigo is a name that is on the smaller side. This is the type of name we love to get involved with. It has an enterprise value today of, let's see, I'm just pulling that up, $180 million Canadian. This company is not really a mining company per se. They process the tailings from the El Teniente mine down in South America, which is a huge copper mine. That's had decades and decades of tailings, and they come in and they remediate and clean those tailings and they process them. And in the tailings pile of that mine, there's actually quite a bit of copper in them in it. So if you look at the economics, I don't have the model right in front of me, but if you look at the economics, like they're off the charts. There'd always been a worry that the tailings mine, the tailings operation would have a limited life of mine, but they've addressed that with a new capital project that now opens up a new block of tailings that allow them to continue for a number of years. It's just this tiny, unfollowed, unloved company that generates good cash and will continue to generate pretty strong value at these copper prices. I'm looking here last year, on a market cap or an enterprise value rather of 175 million Canadian. It did $90 million in free cash flow. It's not bad. 2 times cash flow.
Not bad at all. And maybe speak a little bit about how you evaluate exploration companies like Trilogy Metals.
Yeah, sure. Look, exploration is more difficult, clearly. It's more binary. One of the tools that I think has been really interesting in terms of exploration over the years has been to try to get involved and try to look, right as these sort of what they call in Canada, the 43-101 reports, which is to say the technical report that really tries to lay out the scale and scope of the mine, right as that's coming out, because, oftentimes mine companies and investors and analysts are almost, they find it impossible to try to estimate what these plans are going to look like. They say, look, I need to see the engineer's report. And that's totally true. You absolutely do. However, if you can get a sense of the scale and the scope of the project, and if you can understand, one of the things I've found incredibly important is to understand the geometry of these ore bodies, which helps you to understand how they'll be developed and how much infrastructure needs to go in and how much milling capacity and how many shafts and things of that nature. You can get within an order of magnitude of the ultimate mine plan and feasibility. Now, that's obviously not going to be enough if you had to buy the project and own it as your only sole asset in your mining company. But as an investor who can own it as a small percent of the portfolio, sort of sub 1% in a diversified approach, that can be really, really interesting, particularly, if nobody else wants to own it. So it's just trading at sort of option value, if you can try to get your arms around that. So that's the case, with these larger or with these sort of earlier stage projects. So if you look at a project like Trilogy, they have the Ambler project, which is, again, they do now have a feasibility study. It came out in 2020, but we've been involved in the lead up to that. There you have a project that was going to be very high grade. What the actual grade was going to be ended up being 2.2% copper grades. We had to remain to be seen, but the drill holes that were coming out were extremely high grade. So it was going to be high grade, which right off the bat means that it's going to could potentially be, an efficient project in terms of capital cost to develop, et cetera. It was, potential to be big and growing. The geology looked very, very strong. It was a VMS deposit, which is, for the non-geologists, they call it a volcanogenic massive sulfide deposit, which one of the interesting things about them is that where there tends to be one of them, there tends to be several. And so there's good upside potential in the district as they continue to map out these different VMS lenses. They basically are formed when you have underwater volcanoes that make contact with the water. And so as that lava and as all those liquids come out of the volcano, they immediately precipitate the metal because it cools, in the deep waters, and it precipitates the metals in these big lens forms. Where you get one, you tend to get many. They tend to be high grade, and so and the team and the history of the project is very, very robust. It was had to do with Nova Copper and earlier Nova Gold as well, which, if you look at some of the people behind that, including Mr. Kaplan and things like that, they've had a pretty good indication of success over the years. So that's how, we've been following it for a long time. They have a joint venture with Trilogy, with South 32, which itself was a spin out, I think, of BHP. So sort of further validation. And so, it's a name that we like. Ultimately, we think that company, I'm going to pull up again my price target sheets here. But it's basically trading at, 10 or 20 cents on the dollar in terms of its long-term net asset value.
Can we talk a little bit about your framework for analyzing oil services companies?
Sure. Oil services companies are, a little bit different than some of the other companies that we look at, because ultimately, we are looking there at sort of recurring earnings streams and recurring revenue streams. And it's not, finite. It's not a question of trying to model the individual deposit and model the economics of the deposit, but rather you're looking at, revenue trends. You're looking at marginal, incremental margins in the business, which tend to move with the cycle. So, as the oil cycle moves lower, in this case, over the last 4 or 5 years, these companies have been absolutely decimated in terms of their valuations because of the fact that budgets have been slashed, 75% from peak to trough. And so if you think about that capital spending on the oil company side of things, that's effectively the revenue on the oil service side of things. And so you end up with this sort of death spiral, if you will, and happening in reverse, where you have fixed costs that are constantly needing to be rationalized. Otherwise, they're going to be spread over less revenue. And so your margins collapse, what have you. If you can get the cycle right, then as the oil price begins to move higher, companies see their drilling budgets expand. That moves into the equipment side of things, into the oil service side of things. You start to regain pricing power, and that at its best, works out to have very, very strong incremental margins because you're able to run that marginal revenue through, a fairly lean cost base. And so you kind of get this double whammy where you have growing earnings, growing revenue, growing earnings, and then as investors begin to enjoy the return on capital there, you start to see money come in and you get improved valuations there as well. And that's why, if you look back at that peak in 1980 that I mentioned, when oil and gas equities represented 30% of the S&P 500, the second biggest stock, was almost the biggest stock, I think for a day it maybe was, but in the stock market, I think actually in the world, was Schlumberger, which was considered the quintessential growth company. It was considered, the absolute kind of darling of the market and something that absolutely everybody needed to own. And that's because you were coming off the end of a very strong cycle there that saw earnings growth, earnings grow dramatically rather. So this last capital spending budget has been very, very dramatic. Like I said, it's been the sharpest decrease in capital spending amongst the energy companies that we've ever seen. The service companies have been direct losers in that game, but that cycle is now turning and it's about to move. It's going to have to move higher. So we think that you're going to start to see really, really strong both revenue trends, cost trends. One thing that's been remarkable, if you look at like Schlumberger, the way they've been able to cut costs in the downturn, I mean, it's just been shocking. And so we've actually, that's been sort of our bellwether on the service side of things. We own several others, which I'll talk about here in a second as well. But, in terms of a name like Schlumberger being able to, rationalize and cut those costs on the way down, makes it in a position to enjoy very, very strong recovery here as things get better. We also own a few offshore drilling names in the service bucket. You can debate whether they're services or their own, drilling in a different category, but most people put them in the services category as well. And, we think that if we're right about our thesis on the shales beginning to slow and beginning to exhaust themselves, then we're going to start to need to put more capital to work on the offshore side of things. Offshore is very popular in the early 2000s. It's been completely quiet for the last 10 years. Offshore drilling budgets have fallen even more than the industry as a whole. And those assets are priced at extremely low values. Now, one thing is that if you go back pre-COVID, a lot of those companies carried debt, in order to finance basically a fairly robust new building program that occurred a decade ago. And so that began to violate a little bit one of our kind of concerns where we like to stay away from companies with debt because of the risk that they would permanently impair the capital. We ultimately felt that a lot of that debt was manageable given the fact that it was asset backed in some cases, and given the fact that we felt that even if things kind of plodded along at a relatively low level, they would be able to make and service that debt for the next number of years for us to be able to enjoy a recovery. Unfortunately, with COVID, we had another leg down, and a couple of the names that we did hold actually did go into restructuring. We bought some of the bonds at that time, and we actually played them through restructuring. But now what's interesting is that the companies that needed to restructure have all done so. Their debt loads have been wiped out. And so, and what's been interesting is that some of these restructurings have been quite complicated and have taken, over a year for the names to publicly list again. I'm thinking of Diamond Offshore in particular. And so you now have, from a value approach, the situation that Mr. Greenblatt loves, where, you have a company that comes out of bankruptcy, comes out of restructuring, sort of forced selling, people that have been forced to hold this name for a year or whatever. They said, just get me out. And so I think that could be some really strong opportunities in the offshore drilling sector there. If you look at, day rates beginning to recover, even where they are now, these companies will generate considerable free cash over the next 3 to 5 years.
Yeah, absolutely. I think that makes a lot of sense. And for a concluding question, what do you look for in college students who dream of one day working at Gehrig and Rozencwajg Associates?
One of the things that's interesting, it's a tough question. I'm the only person that Lee's ever hired to work for him, and I've never hired anybody. So I don't really know what I'm looking for, at all. But one thing that I will say when I talk to, younger people that are interested in value investing, I would say that I do feel that to be a true value investor is something you kind of have to just be. I don't know that it's necessarily taught. I could show someone a stock chart that's down 85% and is trading below book value. And to a lot of people, that chart looks really daunting and scary, and there's really little appeal, and say, oh my God, it's probably going to keep going down. And other people look at that and say, oh my goodness, that's an unbelievable opportunity. And what I found in talking to people is that, you know, it's rare to find true value investors. It's rare to find people that actually, you know, are happy to see something go down, because it means they can add to their position and lower their cost. And, you know, there's very few people that actually think that if a stock falls 50%, it has less risk than it did 50% ago. And if you say that to somebody, you know, I bet 9 people out of 10 would say, oh my God, that's a really risky stock. And the other would say, well, no, it has less risk now, because it's actually, you know, you've removed half the value. The business is the same, but you've removed half what you're paying for it. That, I think I'd look for that type of person, which I think is just kind of an outlook. I don't know that that's really something that you can teach. And I think the other thing is that, like, you know, if you're a true value investor, you know, it's really hard to be a true value investor. You know, a lot of people kind of puff their chest and say, oh, I want to be a value, but it's sort of miserable. You're always alone, and, you know, people kind of calling you stupid all the time. And, you know, you have to contend with the market moving against you. You know, it's much, there's many days where I wake up and say, oh, I wish I could just kind of go with the crowd, but you're just not wired that way. So I think that's what you kind of have to look for.
Adam, Javier, it was a pleasure. Thank you so much for your time today. We really appreciate it. This is a really tremendous session. Thank you so much.
Thank you for having us.
Excellent. Have a great day. Thanks.